In a single year, 2008, American households lost $19.2 trillion in net worth. Not misplaced. Not transferred. Gone. To put that in perspective, that's more than the entire GDP of the United States at the time. It's the combined output of every American worker, every factory, every farm, every business, for an entire year, erased. But here's what they never tell you in the history books. The people who built this disaster didn't think they were building a disaster. They thought they had invented something brilliant. A machine that turned risk into safety. A financial innovation so clever, so elegant, that it seemed to have defeated one of the oldest laws of economics. By the end of this video, you'll understand exactly what that machine was, and the one small, catastrophic flaw hiding inside it. Let's go back to 2003. America is climbing out of a recession. The dot-com bubble has burst. The country is still shaken from 9/11. And the Federal Reserve, under Chairman Alan Greenspan, makes a decision: slash interest rates. The idea is simple. Cheap money makes people spend. People spend, the economy grows. And it works. Mortgage rates fall to historic lows. Suddenly, buying a home becomes cheaper than it's ever been. A family that couldn't afford a $200,000 house 2 years ago can now qualify for the monthly payment. So they buy. And then another family buys. And another. And another. Home prices start climbing. 10% one year. 15% the next. In some markets, Miami, Las Vegas, Phoenix, homes are doubling in value within 3 years. Here's what's critical to understand: this felt rational. If home prices were going up 15% every year, it made sense to buy now, even if you stretched your budget. Even if you couldn't quite afford it, because in 2 years, you'd have so much equity you could refinance on better terms. You couldn't lose. Banks started believing the same thing. If a borrower couldn't repay, the bank could just foreclose, sell the house at a profit, and come out ahead. The collateral, the house itself, seemed to guarantee the loan. So banks started lending to people they never would have touched before. People with poor credit. People with no income verification. People with no down payment. These were called subprime loans, loans that carried higher risk and higher interest rates. And then someone on Wall Street had an idea. What if you could take thousands of these risky mortgages, bundle them together, and sell slices of that bundle to investors? What if you could mathematically transform a collection of risky loans into a product that ratings agencies would stamp with a AAA safety rating, the same rating as U.S. Treasury bonds? That product was called a collateralized debt obligation, a CDO. And it was about to change everything. Meet Gary. Gary isn't a real person, he's a composite drawn from thousands of documented cases. But his story is completely typical of what happened to ordinary Americans during this period. In 2004, Gary is 38 years old. He works as a contractor in suburban Phoenix, Arizona. He makes decent money, around $58,000 a year, but his credit score has some blemishes from a medical debt a few years back. He's been renting for a decade. His mortgage broker calls him one afternoon. There's a new program, the broker explains. No down payment required. The first 2 years, Gary's monthly payment would be just $890. After that, it would adjust, but by then, the broker says cheerfully, Gary's home will have appreciated enough that he can refinance. Gary doesn't fully understand what adjustable rate means in practice. He doesn't know that after the introductory period, his payment could jump to $1,800 a month, or more. The broker doesn't dwell on that part. What Gary does understand is that he's been paying $850 a month in rent for years. Now he can own something, a 3-bedroom house with a yard, for almost the same payment. He signs. Gary is not stupid. Gary is not reckless. Gary is doing exactly what the entire system has been designed to encourage him to do. His mortgage is sold to a bank within weeks of closing. That bank bundles it with 3,000 other mortgages. The bundle is sliced, rated, and sold to a pension fund in Norway, a sovereign wealth fund in Singapore, and a hedge fund in Connecticut. Gary's mortgage, his house, his yard, his future, has become a global financial instrument. For now, everything is fine. Gary makes his payments. His home is worth $248,000, up from the $210,000 he paid. On paper, he's made nearly $40,000 in 2 years without doing anything. He thinks he's made the smartest financial decision of his life. Back on Wall Street, the CDO machine is running hot. By 2006, investment banks are creating CDOs faster than they can find mortgages to fill them. So they start filling them with other CDOs. CDOs made of CDOs, called CDO squareds. Risk layered upon risk, repackaged and re-rated, until even the people selling them aren't entirely sure what's inside. The The crack appears in early 2007. Home prices stop rising. In some markets, they begin to fall. This is not supposed to happen. Every model, every projection, every sales pitch had assumed one thing, that nationally, home prices would at least hold steady. That assumption is now dead. Delinquency rates on subprime mortgages start spiking. Homeowners who bought at the peak, many of them with adjustable rate loans that have just reset to unaffordable payments, are falling behind. And unlike during the boom, there's no appreciation to bail them out. The houses are worth less than the mortgages on them. They're underwater. In February 2007, HSBC, one of the world's largest banks, announces a $10.5 billion loss from bad American mortgage loans. It's one of the first public admissions that something is deeply wrong. In June 2007, two hedge funds run by Bear Stearns, one of Wall Street's oldest and most respected investment banks, collapse. They had been heavily loaded with CDOs tied to subprime mortgages. Investors get back almost nothing. The word crisis is whispered for the first time. But the real shock comes in September 2008. On the weekend of September 13th, the U.S. Treasury and Federal Reserve hold emergency meetings. Lehman Brothers, a 158-year-old investment bank, the fourth largest in the United States, is out of money. It's sitting on $600 billion in debt. No buyer will take it. The government, which had rescued Bear Stearns months earlier, decides, not this time. On Monday, September 15th, 2008, Lehman Brothers files for the largest bankruptcy in American history. The markets detonate. The Dow Jones drops 504 points in a single day. The next day, AIG, that insurance company that had sold hundreds of billions in credit default swaps, announces it's lending to each other, because no one can tell, anymore, which bank is holding toxic assets and which isn't. A money market fund breaks the buck, its value drops below $1, and ordinary Americans start to panic. Lines form outside branches of Washington Mutual, the largest bank failure in U.S. history, which collapses days later. It is not a recession. It is a near-extinction event for the global financial system. Let's go back to Gary one last time. It's November 2008. 2 months after Lehman collapsed. Gary lost his job in October. Construction in Phoenix has stopped. Completely. There's nothing to build, nobody is buying. His employer laid off 80% of the staff in a single week. Gary's adjustable rate mortgage is now $1,680 a month. He has $400 in his savings account. He calls the bank. He's told that modification programs are being developed. He's told to keep making payments as long as he can. He's told, gently, that the bank understands this is a difficult time. He makes one more payment with a credit card. Then he stops. In February 2009, he receives a foreclosure notice. Gary packs what fits in his truck. His home, which he bought for $210,000, is auctioned on the courthouse steps for $89,000. The bank takes the loss. But so do the Norwegian pension fund, the Singapore fund, and the Connecticut hedge fund that were all holding slices of Gary's mortgage inside a CDO that no one can accurately value anymore. Gary moves in with his sister. He is 43 years old and starting over. He is one of approximately 3.8 million Americans who received foreclosure filings in 2010 alone. He is not exceptional. He is not a cautionary tale of greed. He is what happens when an ordinary person is handed a product designed to fail by people who knew, or should have known, that it would. The numbers, when they finally settled, were staggering. The U.S. economy shed 8.7 million jobs between 2008 and 2010. The unemployment rate hit 10%. GDP fell by 4.3%, the steepest drop since the Great Depression. American households lost $13 trillion in wealth in 2008 alone, with the full toll reaching that $19.2 trillion figure by the end of 2009 when housing losses were fully counted. The government response was unprecedented. The $700 billion TARP bailout. The Federal Reserve printing money on a scale never seen before. Congress passed the Dodd-Frank Act in 2010, the most sweeping overhaul of financial regulation since the 1930s. It created the Consumer Financial Protection Bureau, tightened lending standards, and attempted to put guardrails around the kinds of derivatives that had amplified the collapse. In 2008, over 10% of all U.S. mortgages were delinquent or in foreclosure. Some neighborhoods in Detroit, Cleveland, and Phoenix still haven't fully recovered. And what was the fundamental flaw in the machine? It was this: the entire system assumed that housing prices could not fall nationally and simultaneously.